Imagine a football stadium, right? And every minute, one drop of water is added to the stadium, and every minute, the number of drops you add doubles. So it goes from 1 to 2 to 4 to 8 to 16 drops. And you say, how long would it take to fill this stadium? And you think, a day, a month, a year? No, it would take 50 minutes to fill the stadium, which is amazingly short. But the more interesting thing is think at how it ends. It's hard to understand how full the stadium would be after 45 minutes. You ask people, well, how full is it after 45 minutes? And people might think, well, it's pretty damn full because you're getting near the end. No, at 45 minutes, the stadium is only 7% full. Okay. So in the last 5 minutes, the stadium goes from being 7% full to being 100% full.
With almost $200 trillion in funded and unfunded debts, debt to GDP of over 120%, and rapidly growing interest expenses, it is quite clear that the United States is on an unsustainable fiscal path. An unsustainable fiscal path is the exact phrasing of the U.S. Department of Treasury as stated in the executive summary to the fiscal year 2022 financial report. Macro analysts and prominent investors, both from the traditional financial sector and alternative sectors like Bitcoin and gold, have been talking about the brewing debt storms for years. Prior to 2022, with interest rates kept artificially low for such a long time, it was easy for policymakers to downplay the problem and make it seem like all was well. That's quite impossible now. The cracks are not just showing. They are practically tripling over themselves now, so that institutions that previously backed the reckless monetary policies and even benefited from their follies are now forced to speak out against the situation. An example is the recent downgrade of the United States credit rating from AAA to AA+ by Fitch. The credit rating agency joins the S&P, which downgraded the U.S. credit rating years earlier after the multiple quantitative easing rounds announced in the wake of the global financial crisis in 2008. Investment manager and sound money advocate Lepard recently appeared for an interview on Swan Bitcoin, alongside macro analyst and former hedge fund manager James Lavish. During the highly informative discussion, the duo discuss, amidst other things, the United States debt spiral and how exponentially it has grown over the years. Lepard points out that during the 2008 crisis, the Federal Reserve pumped hundreds of billions of dollars into the economy to rescue the banks. With each crisis after that, it needed more and more, and by the time the pandemic rolled around, it ended up printing more than it had in the first 2 centuries after its founding. Lepard explains that a pattern has now been established, a vicious pattern of crisis after crisis caused by reckless monetary policies and even more reckless policies to keep them in check. As such, he predicts that the U.S. will need to print more and more until no amount of printing can save the economy. A little at first, then all at once. That's the outcome Lepard and Lavish expect for the United States' incredible debt situation. We will now bring you clips from the discussion. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks and enjoy the video.
The system we're built on is we're so over levered right now, and all the cracks are starting to show. And so, we've seen the markets melt up. We've seen just money pour into risk assets, and I don't trust it, Sam. I feel like I've been in this game long enough to know that you've got to watch out for that black swan that you don't see, but you get this spidey sense. And I'm sure Larry's felt this a number of times before in his career, where you're just like, there's just too many signs out there that something could break. And the leverage in the system is not only the trigger, but it's also just that weight that'll bring everything down that you just have to be aware of.
This whole system is so broken. It's such a sick joke. I mean, fiat is basically failing as we speak. And it reminds me, I'm a pilot, it reminds me very much of, when you get into, if you're flying IFR and you lose control of the plane, what you tend to do is you want to pull back on the stick. And that tightens up the spiral and makes it worse, and you only crash faster. And what the Fed has done, what Powell has done, is he pulled back on the stick by putting interest rates up as high as they've gone. And you're watching the U.S. interest expense just go parabolic, right? And I mean, this is it, folks. I mean, we're in the end game here. It's obviously going to take a little time to play out. It doesn't happen in days, but it's happening. I mean, there's no going back at this stage.
Yeah. So for people to understand, I mean, we've borrowed another $1 trillion since the beginning of June. Okay. So our debt is up over $36.5 trillion, or I'm sorry, $32.5 trillion. The Treasury just expects, they just put out that they expect to borrow, wait for it, $1.86 trillion in the second half of 2023. That's after borrowing 1.3 trillion in the first half. So,
and that was, by the way, that was 300 or 400 higher than what they projected as recently as 3 or 4 months ago. So
that's
it's
right.
just it's getting worse and worse, right?
Yeah, and like you said just a second ago, Larry, you know, we're on track to pay about $1 trillion on interest on our debt this year. $1 trillion.
Yeah, which is basically larger than the U.S. Defense budget. It's the defense budget is in 800 range. So
that's right. That's right.
Yeah, I mean, look at that parabolic rate, right? I mean, that.
Yeah.
How does this end well?
The best part about this chart right here, and hat tip to Lynn Alden, who was the first one to find it, but this was actually this was published by the Treasury. And it was in a report. It was the State of the Treasury report, and it's basically a love letter, hate letter to Congress, saying, this is the path we're on. And it was that was not my subtitle. That was their subtitle to the report: an unsustainable fiscal path. And they know it. They absolutely know it, and they're trying to get Congress to look. The Treasury, they're the bank account. They're the banker. They're like, they're like the money manager who's trying to get the rock star to stop spending so much money. He's going to be broke. That's who they are. And they just have to keep issuing debt in order to pay for everything that Congress has agreed to purchase. And so, they understand that this is just not mathematically sustainable.
The entire world watches the way that we behave, and we're behaving incredibly irresponsibly, and yet we have to, because you can't taper a Ponzi, as Max Kaiser points out. And so, although Powell is trying to do the impossible, which is calm down the monetary excess, which they started when they printed 42% of the money supply in a 2-year time frame, he's not going to succeed at it. He has to fail. Or if he wants to make the dollar money good, he has to completely crater the leveraged economy that we live in today, and we'll have something that'll look like the 1930s.
During the discussion, Lepard and Lavish described that a lot of this mess started with former Fed Chair Alan Greenspan and Greenspan put the monetary policy actions he announced in the aftermath of the 1987 stock market crash. Immediately following the crash, Greenspan said the Fed was ready to serve as a source of liquidity to support the economic and financial market. This birthed the Greenspan put, an initiative that soon led to periods of extreme speculation led by Wall Street investment banks overusing the puts repurchase agreements and creating successive asset price bubbles. The Fed and Treasury Department have had to rescue the markets several times after that, giving us the Bernanke put during the global financial crisis and the Yellen put of low interest rates and more key during her time as the chair of the Federal Reserve. As problematic as these policies have been, Lepard explains the really problematic aspect is how much they have worsened over time. As an example, he compares the monetary intervention announced during the 2008 crisis to the QE rounds announced in 2020, adding that U.S. debt will continue to grow exponentially. Lepard and Lavish also use interesting analogies that really put the situation into perspective. Here are more clips from the interview.
So in 2008, we went from $1 trillion to $3 trillion over the course of 3 or 4 years with QE 1, 2, 3, et cetera. In 2020, we went from 3 and change to 9 in the space of 9 months. I mean, it's nuts. I mean, and the next one will be 20 trillion. And this is my point. This is the point about exponential growth. And I think the average human mind just doesn't fully grok exponential growth and the way things can compound, and the way that once lines start to go very vertical, the second derivative becomes extremely high, and the system is unstable and it's going to explode. This is, I'm borrowing this. None of my ideas are original, by the way. I borrowed damn near everything I've got. I'm borrowing this from Egon von Greur.
Like the U.S. government.
Yeah, it was a gold guy in Switzerland. I just find this amazing. So imagine a football stadium, right? And every minute, one drop of water is added to the stadium, and every minute, the number of drops you add doubles. I did the math on this, and I think it comes out accurately. I could be a little wrong, but it makes the general point, even if it's slightly off. The general point is correct. So it goes from 1 to 2 to 4 to 8 to 16 drops. And you say, how long would it take to fill this stadium? And you think, a day, a month, a year? No, it would take 50 minutes to fill the stadium, which is amazingly short. But the more interesting thing is think at how it ends. It's hard to understand how full the stadium would be after 45 minutes. You ask people, well, how full is it after 45 minutes? And people might think, well, it's pretty damn full because you're getting near the end. No, at 45 minutes, the stadium is only 7% full. Okay. So in the last 5 minutes, the stadium goes from being 7% full to being 100% full. That's what we mean when we say, I went bankrupt slowly and then suddenly all at once.
Yeah.
I mean, the compounding of the math in these situations, people don't understand it. And so when this happens, and we can get into what I think is the timing on it all. When this happens, people are going to be absolutely shocked. And there's a great Weimar chart that shows the volatility and how it happens. And we're still in the early days. I mean, my outside goal for outside target for when this happens is going to happen before 2032, no doubt in my mind. Probably it's going to happen late 2028 or 29. That's kind of my estimate. But when they have to reverse the one we're in right now, the Fed balance sheet's going to double again, and inflation's going to roar again, and the price levels are going to go up again, and gasoline's going to be $10 plus again. And I don't know what they'll do to try and get all that under control, but they'll do something, and then maybe there'll be a downward impulse. But you can kind of see where we're going here.
Well, issue and monetize debt. And then to your point there, Larry, one of Jeff Booth's favorite examples is how many folds of a piece of paper does it take to get to the moon from here?
Right.
And it's 42 folds. Okay, so that's fine. But if you think about it, you're at fold 40, you're only a quarter of the way there. 41, you're halfway. 42, you're there.
Right.
Boom, done.
Right. Same idea. The human mind doesn't really understand exponential functions very well. Here's the issue. It's going to happen again. And when it does, we've seen it over and over. I can cite 20 instances of where when the rubber meets the road, the Fed fulfills its initial guideline. When it was set up in 1913, it was meant to be a lender of last resort. And it didn't take them but 3 years, and that's what they became. In 1916, they funded World War I by printing money, and they weren't supposed to. And guess what? They've been doing it ever since then. Over 100 years of, when the rubber meets the road, they will print the money, which is why James and myself, and I know you too, Sam, are just so absolutely comfortable that monetary debasement is inevitable. This is a criminal system that is incredibly unfair to people throughout the entire world. And it's why it's absolutely essential, in my view, that we've got to fix the money to fix the world.
James Lavish perfectly summarizes the situation in a recent string of tweets with charts describing just how dire the U.S. debt situation has become. The tweets read, "The U.S. operates in a perpetual and growing deficit, forcing it to borrow more and more every year to make up the difference. An interest payment on that borrowing is skyrocketing, making matters exponentially worse. The result the reformed hedge fund manager concludes will be a parabolic growth in the situation that will cause even more destruction and chaos." What are your thoughts on the interview? Please drop your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.